Right, let's take it across to the big macroeconomic data released today, and there's some cheer for the Indian economy coming in. While retail inflation continues to edge lower, there is finally some relief on the industrial output front, with the February IIP number posting an uptick of 2%. Let's take it across to the expert. Latha Venkatesh joins us with all the details. Thanks so much for joining us, Latha. Is it time to really celebrate?
Yes, sir. It is time to celebrate on inflation for sure. The inflation number has come in at 4.83% compared to expectations of 5.05. So that's a good 25 basis points lower than expected, and compared to 5.18 in the month of February. So that's again a 40 basis point fall. Within that, even the food inflation number has come in at 5.2 compared to 5.3% in the month of February. Within that, whether you looked at vegetables or whether you looked at pulses, all these are tricky items which can rise as winter ends. But all across, we see these inflation numbers lower than what they were in February, even though pulses inflation at 34% is high in year-on-year terms. Month on month, it's fallen. The most important number really is the services inflation, whether you look at education, health, recreation, personal services, all of them have receded compared to their month ago levels. And more importantly, this services inflation, called core inflation, has come in at 4.75 compared to 4.9% in the month of February. So that is even the non-volatile element that is showing showing signs of dipping. Expectations are that gives the Reserve Bank some space to cut rates later on in the year, coupled with a good monsoon that can mean even further fall in prices. The industrial output number again is important simply because although it is only 2%, it is better than the CNBC TV18 poll, which said 1.5%. Within the IIP number, manufacturing has come in only at 0.7%, but the two highlights are electricity, which has come in at 9.6%, and consumer durables, which have come in at 9.7%. Both those are very positive, indicating an uptick in consumption. However, the negative is that capital goods have degrown, have contracted by 9.8%. So investment or capex continues to be a sore point as well. The consumer non-durables, the perishable goods, are again growing at a very paltry 1 to 2%. So those are the pressure points, but overall still better than expected.
All right. Thanks, Latha, for taking us through all those details. And this should cheer the Indian markets come tomorrow.